In the autumn of 1979, two Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt began executing what would become the most audacious market manipulation attempt in modern commodity history. Over the course of several months, they accumulated nearly 200 million ounces of physical silver and silver futures contracts, driving the price from $11 per ounce to an astonishing $50 by January 1980. When regulators finally intervened and the scheme collapsed on what became known as Silver Thursday, the price crashed to $10, nearly triggering a systemic financial crisis. The Hunt brothers were eventually fined and their fortune decimated, but they left behind something unexpected, a price peak that, adjusted for inflation, has never been matched in the 45 years since. That $50 price in January 1980 translates to approximately $150 to $170 in today's purchasing power using standard government inflation measures. Some alternative calculations, accounting for changes in how inflation is measured over the decades, place it as high as nearly $1,000. Yet today, as 2025 draws to a close, silver trades around $58 per ounce, having risen dramatically over the past year, yet still sitting at roughly 80% below its inflation-adjusted historic peak. This presents a puzzle that has confounded both skeptics and believers in the silver market for over a decade. How can a metal trade at such a steep discount to its real historical value, while simultaneously experiencing the strongest fundamental demand dynamics in its entire industrial history? The answer to this puzzle requires understanding a transformation in the silver market so profound that it challenges every assumption about commodity supply and demand built up over centuries of economic thought. Silver is no longer primarily money, as it was for 4,000 years of human civilization. It is no longer primarily an investment vehicle, as it became during the 20th century's various financial crises. Today, silver has become something far more critical to the functioning of modern civilization. It has become the irreplaceable nervous system of the global energy transition, the one material without which humanity's climate goals become physically impossible to achieve. Walk into any solar panel manufacturing facility in China, India, the United States, or Europe, and you will witness the consumption of silver at a scale that would have been unimaginable even a decade ago. The global solar industry consumed 60 million ounces of silver in 2015. By 2024, that figure had exploded to 232 million ounces, a nearly four-fold increase in less than 10 years. To put this in perspective, the entire global silver mining industry produces approximately 820 million ounces annually from all sources. The solar sector alone now accounts for nearly 19% of total global silver demand, and that percentage continues to climb with each passing quarter. The physics behind this consumption are brutally simple. Every solar panel contains a thin layer of silver paste applied to photovoltaic cells in a precise grid pattern. When sunlight strikes the cell, electrons are freed and must be efficiently collected and transmitted. Silver, possessing the highest electrical conductivity of all metals, performs this task with unmatched efficiency. Researchers have spent decades attempting to find substitutes copper, aluminum, various alloys, and conductive polymers, but none can match silver's combination of conductivity, corrosion resistance, and manufacturability at the temperatures and speeds required for mass production. The solar industry is, in the bluntest terms, addicted to silver with no viable path to withdrawal. What makes this addiction particularly acute is a technological shift occurring within the solar industry itself. The workhorse solar cell design of the past decade, called PERC technology, used silver only on the front surface of each cell. Newer, more efficient designs with names like TOPCon and heterojunction achieve higher energy conversion rates but require silver on both the front and rear surfaces. These advanced cells consume 50 to 100% more silver per panel than their predecessors. As the industry transitions to these technologies to squeeze out every possible efficiency gain driven by both competitive pressure and the physics of reaching theoretical conversion limits, silver intensity per unit of solar capacity is rising rather than falling. The industry is using more silver per panel even as it desperately tries to use less. The scale of solar deployment planned for the coming decades staggers the imagination. Global solar capacity doubled from 1 terawatt to 2 terawatts between 2022 and 2024, far exceeding even optimistic projections from just a few years earlier. Government climate commitments require this exponential growth to continue. The United States aims for solar generation to surpass coal by 2030. China plans hundreds of gigawatts of annual installations. Europe scrambles to reduce dependence on Russian natural gas through accelerated renewable deployment. India builds domestic solar manufacturing capacity at breakneck speed. Every one of these panels requires silver, and the cumulative demand by 2030 is projected to consume between 10,000 and 14,000 tons annually, representing 29 to 41% of total global silver supply, assuming supply even remains constant. But supply is not constant, it is declining, and the reasons why reveal structural problems that higher prices alone cannot quickly solve. Understanding this requires grasping a peculiar fact about silver mining. Very few miners actually mine silver. Approximately 70 to 80% of global silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When a mining company operates a copper mine in Chile or a lead zinc operation in Australia, silver comes along as a bonus credit that improves project economics, but does not drive investment decisions. If silver prices double, the copper miner does not suddenly produce more copper to get more silver. The mine's production plan follows copper prices and reserves. This byproduct structure makes silver supply remarkably inelastic to price signals compared to other commodities. The remaining 20 to 30% of supply comes from primary silver mines, where silver is the main product and production decisions do respond to prices. But these operations face their own constraints. Global silver ore grades have declined approximately 20% over the past decade as miners exhaust high-grade deposits. Opening new silver mines requires 7 to 10 years from discovery through permitting, financing, construction, and ramp up to full production, far too slow to respond to current deficits. Mining costs have risen sharply due to inflation in labor, energy, equipment, and regulatory compliance. Several major producing nations face political or infrastructure challenges that constrain expansion. Mexico, the world's largest producer, has seen output flat or declining due to resource depletion at major mines and periodic labor disputes that shut down production for months at a time. The result is a mining supply base that has been essentially flat for nearly a decade. Production peaked in 2016 at 900 million ounces and has since declined by an average of 1.4% annually. In 2024, global mine production rose by less than 1% to approximately 820 million ounces, a negligible increase that does nothing to address the structural imbalance. Forecasts for the top 5 producing nations show production declining by 19 million ounces by 2029, driven primarily by a 13% drop in Mexican output as major mines age and ore grades deteriorate. Recycling provides some additional supply, reaching a 12-year high of nearly 194 million ounces in 2024. Higher prices encourage people to sell silver jewelry, silverware, and coins back into the market, particularly in Western nations where cost of living pressures made selling family heirlooms financially attractive. Industrial scrap from manufacturing processes and spent catalysts contributed as well. But recycling remains a relatively small fraction of total supply and is itself constrained by the availability of scrap and the economics of collection and refining. You cannot recycle silver that does not exist in recyclable form, and an increasing proportion of silver consumption is going into products like solar panels that have decades-long life cycles before recycling becomes possible. When annual consumption exceeds production plus recycling, the difference must come from somewhere. That somewhere is above-ground stockpiles, the inventories held in exchange warehouses, bank vaults, and private holdings accumulated over previous years of surplus production. These stockpiles are being drawn down at an alarming rate. In 2020, identifiable silver stocks represented approximately 22 months of global supply, providing a comfortable buffer against temporary imbalances. By 2024, that cushion had collapsed to just over 12 months, and the trend continues accelerating. The cumulative deficits tell the story with brutal clarity. From 2021 through 2024, the silver market consumed approximately 678 million ounces more than was produced, equivalent to 10 months of total global mine output. These deficits are not statistical artifacts or accounting irregularities. They represent real metal drawn from real vaults and sold into real industrial consumption. The COMEX exchange in New York, one of the world's major silver storage facilities, held over 400 million ounces in early 2021. By late 2024, that figure had declined to just under 300 million ounces. London vaults, which service the global over-the-counter market, have seen even steeper drawdowns from approximately 1.2 billion ounces in 2020 to around 750 million ounces by mid-2025. China presents perhaps the most telling case study in inventory depletion. For decades, China was a surplus silver market. The nation imported copper and lead zinc concentrates from around the world, processed them domestically, and exported the byproduct silver, typically at a slight discount to London prices. This dynamic began changing in late 2023. Chinese silver discounts to London narrowed, then disappeared, then turned into premiums. Silver exports from China slowed as domestic industrial demand, particularly from the massive solar manufacturing sector, consumed local production. The Shanghai Gold Exchange, which had historically been a source of silver supply to the West during periods of tight Western markets, began drawing down its inventories. These are not the behaviors of a market with adequate supply. They are the behaviors of a market consuming stockpiles built up over previous decades. Financial historians studying commodity markets recognize certain patterns that recur across centuries and asset classes. One of the most reliable is mean reversion, the tendency of extreme relative valuations to eventually normalize. The gold-silver ratio, which measures how many ounces of silver are needed to purchase 1 ounce of gold, provides such a metric. Over the past 50 years, this ratio has averaged approximately 53 to 1. Throughout most of 2024, it fluctuated between 75 and 90 to 1, meaning silver was trading 30 to 40% below its long-term relative value to gold. History shows that when this ratio exceeds 80, silver has subsequently rallied by 40%, 300%, and 400% on 3 separate occasions. The ratio briefly touched 125 to 1 in March 2020 during the pandemic panic, arguably the highest level in millennia of these metals trading history, before rapidly contracting as investors recognized. The extreme undervaluation. What makes the current elevated ratio particularly notable is that gold itself has been reaching all-time nominal highs, surpassing $4,200 per ounce in late 2025. Silver's failure to keep pace suggests one of two possibilities. Either the market systematically undervalues silver's supply constraints and demand dynamics, or a mean reversion of historic proportions lies ahead. Given that the fundamental case for silver appears stronger than at any time in modern history, with structural deficits, record industrial demand, and depleting stockpiles, the latter possibility demands serious consideration. Beyond solar panels, silver's industrial consumption spans virtually every corner of the modern economy in ways most people never consider. Electric vehicles, the automotive industry's inevitable future, require 25 to 50 grams of silver per vehicle, compared to 15 to 28 grams for traditional internal combustion engines. As global EV adoption accelerates from single-digit market share to 30, 40, and eventually 50% penetration rates over the coming decades, this translates to tens of millions of additional ounces of annual demand. The electrical grid infrastructure needed to charge these vehicles, transmit renewable energy from remote generation sites to population centers, and manage increasingly complex power flows requires massive quantities of silver in switches, contacts, and conductors. The 5G telecommunications build-out consumes silver in base stations and equipment. Artificial intelligence data centers, with their voracious appetite for electricity and computing power, indirectly drive silver demand through their electrical infrastructure and power electronics. Medical applications, from antibacterial coatings to imaging equipment, employ silver's unique antimicrobial and conductive properties. The list extends across hundreds of applications, each individually small, but collectively consuming hundreds of millions of ounces annually. The critical insight is that these uses are not discretionary or luxury applications that disappear when prices rise. They are structural components of technologies that governments worldwide have committed to deploying as a matter of national policy. The energy transition is not a market-driven phenomenon that will slow or reverse if commodities become expensive. It is a political imperative enshrined in legislation, international agreements, and trillion-dollar spending packages. The Inflation Reduction Act in the United States, the European Green Deal, China's carbon neutrality commitment, India's renewable energy targets, these represent legally binding or politically essential commitments that cannot easily be abandoned without massive political costs. Silver sits at the heart of making these commitments physically possible. This creates a policy dilemma that few governments have fully confronted. If silver prices rise sharply due to supply constraints, solar panel costs increase, potentially slowing the pace of installation. Yet, slowing installation means failing to meet climate targets, which brings its own set of political and environmental costs. Governments and industry planners appear to have implicitly assumed that silver supply would somehow materialize to meet whatever demand the energy transition required, at prices that would not disrupt project economics. This assumption is now being tested in real time, and early indications suggest it was dangerously optimistic. The solar industry recognizes this vulnerability. Multiple research programs worldwide work on reducing silver content per panel through thinner paste layers, better grid designs, and alternative metallization techniques. Progress has been made. Silver loading per watt of capacity has decreased in some cell designs. But this thrifting has been overwhelmed by the sheer growth in capacity deployment and the shift to more silver-intensive cell architectures. The industry is running faster just to stay in place, and the physics of electrical conductivity impose hard limits on how much further silver can be reduced without sacrificing efficiency or reliability. Copper-plated contacts work in some applications but face corrosion and reliability challenges that are difficult to overcome in panels designed to function for 25 to 30 years in harsh outdoor environments. The gap between laboratory demonstrations and mass manufacturing at competitive costs remains vast for most alternative technologies. Economic theory suggests that markets should balance through price adjustment. If silver becomes too expensive, substitution occurs, demand destruction sets in, and eventually new supply emerges or recycling increases to fill the gap. This textbook mechanism is not functioning as predicted in the silver market. The byproduct supply structure means that even at $70 or $75 per ounce, new primary silver supply would take a decade to materialize. Industrial demand has proven remarkably price inelastic because silver typically represents a small fraction of total manufacturing costs, and no viable substitutes exist for critical applications. A solar panel that costs $150 to manufacture does not become uneconomical if silver content costs $6 instead of $3. What matters is the all-in cost versus alternatives like coal or natural gas power. Recycling is increasing but cannot fill gaps measured in hundreds of millions of ounces annually. What remains conspicuously absent from this picture is significant investment demand, the factor that has historically driven silver's most violent price movements. During the 1980 Hunt Brothers episode, investment and speculation drove the price spike. In 2011, when silver reached $49, investment demand from individuals fearing inflation and seeking alternatives to overvalued financial assets provided the fuel. In 2024, despite silver's strong price performance and record industrial demand, investment buying remained notably weak. Coin and bar demand fell to 5-year lows. Exchange-traded products saw only modest inflows after years of outflows. Retail precious metals dealers reported sluggish investor interest compared to the enthusiasm for gold. This investment absence can be interpreted two ways. Perhaps sophisticated investors see risks that industrial demand analysts miss. Maybe substitution will happen faster than expected, or a global recession will crush industrial demand, or above-ground stockpiles are larger than reported. Or perhaps investment demand remains dormant because the supply deficit story has not yet penetrated mainstream financial consciousness. The latter interpretation suggests enormous latent price discovery potential. When industrial off-takers like solar manufacturers bid aggressively against investment buyers awakening to supply constraints, prices can move with extraordinary violence, as history demonstrates repeatedly in commodity markets experiencing structural deficits. Financial historians studying previous commodity supercycles identify common characteristics. Extended periods of underinvestment in production capacity create supply rigidities. Structural demand growth from new technologies or economic development overwhelms these rigid supplies. Inventories draw down past cushion levels into minimum operating stocks. Prices remain remarkably stable during these drawdowns, with markets assuming inventories are adequate until they suddenly are not. Then prices spike violently as users scramble to secure supply, discovering that the marginal ounce trades far above the average production cost. This pattern repeated in copper from 2003 to 2008, in uranium from 2003 to 2007, in rare earths from 2009 to 2011, in lithium from 2021 to 2022, and in numerous other commodities throughout history. The silver market appears to be traversing a similar path, currently in the inventory drawdown phase, where prices have begun rising but have not yet reached the violent spike phase. The question, facing investors, industrial users, and policymakers, is whether the spike phase arrives gradually, providing time for adjustment, or whether it arrives suddenly in a matter of months once critical inventory thresholds are breached. Historical precedent suggests that markets tend to remain complacent longer than fundamentals warrant, then adjust more violently than anyone expects. One must also consider the monetary dimension that distinguishes silver from other industrial commodities. Silver served as money for most of human civilization. The word silver and the word money were synonymous in many ancient languages. The Roman denarius, the Chinese tael, the Spanish real, all were silver coins that formed the backbone of commercial exchange for centuries. Even after most nations abandoned silver for monetary purposes in the late 19th and 20th centuries, the metal retained a psychological association with monetary value that industrial metals like copper or aluminum never possessed. During periods of monetary stress, high inflation, currency debasement, financial system instability, silver has historically attracted safe haven flows alongside gold. The current global monetary environment bears uncomfortable similarities to previous periods that preceded precious metals revaluations. Government debt levels across developed nations have reached peacetime records as a percentage of GDP. Central banks responded to pandemic disruptions with unprecedented monetary expansion. Inflation, dormant for decades, returned with surprising ferocity in 2021 and 2022. And while headline rates have moderated, underlying price levels have ratcheted permanently higher. Real interest rates, the difference between nominal yields and inflation, remain historically low or negative in many jurisdictions. These are precisely the conditions that have historically driven investors toward precious metals as stores of value. Yet silver has not participated in this safe haven bid to the degree that gold has, creating the elevated gold-silver ratio discussed earlier. This likely reflects silver's smaller, less liquid market, making it less suitable for large institutional allocations, as well as its industrial demand component introducing cyclical economic sensitivity. But this very neglect by monetary investors means that when monetary flows do turn towards silver, the market's relatively small size amplifies price impacts. The entire global silver market at current prices represents perhaps $25 billion annually, a rounding error in global financial markets. A 1% shift in global wealth from other assets into physical silver would overwhelm the market's ability to absorb buying without dramatic price increases. Looking forward, the confluence of factors suggests silver sits at an extraordinary inflection point. Industrial demand continues, reaching record levels driven by multi-decade structural trends in electrification and renewable energy. Supply remains constrained by byproduct economics and the long lead times required to bring new production online. Above-ground inventories are being drawn down at an accelerating pace, with 6 years of consecutive deficits having consumed stockpiles that took decades to accumulate. The metal trades at a 70 to 80% discount to its inflation-adjusted historic peak, despite fundamentals that are objectively stronger than during that peak. Investment demand, which has driven previous price spikes, remains largely dormant, representing enormous latent buying power should the supply-deficit narrative penetrate mainstream financial consciousness. And the geopolitical and monetary environment increasingly favors hard assets over financial instruments, whose value depends on the creditworthiness of increasingly indebted governments and financial institutions. The path forward contains numerous uncertainties. Technological breakthroughs could reduce silver intensity in solar panels or other applications faster than currently anticipated, though decades of research have failed to produce such breakthroughs to date. A severe global recession could temporarily crater industrial demand, though the politically driven nature of the energy transition suggests governments would maintain renewable energy support even during downturns. Above-ground stockpiles might be larger than visible inventories suggest, with private holdings cushioning the market, though 6 years of consecutive deficits provide empirical evidence that such hidden stockpiles are already being drawn down. Supply could respond more quickly than expected, though the byproduct structure and long project timelines make this implausible in the short to medium term. What seems beyond dispute is that silver is not priced for the scenario of persistent supply deficits continuing for years while industrial demand continues growing. The market appears to be pricing in either a resolution of the deficit through demand destruction or substitution, or the existence of hidden stockpiles far larger than reported, or a recession that solves the problem through demand collapse. Perhaps one of these outcomes materializes, and the current price proves appropriate. But the risk-reward asymmetry facing anyone evaluating silver appears dramatically skewed. If the deficit resolves benignly, silver might trade sideways or modestly higher, delivering returns comparable to inflation. If the deficit persists and intensifies, if stockpiles continue depleting toward critical thresholds, if investment demand awakens, silver could experience the kind of repricing that periodically occurs in commodity markets when fundamental imbalances reach breaking points. For those attempting to navigate global financial markets in an era of unprecedented monetary experimentation, geopolitical instability, and structural economic transformation, silver presents a unique proposition. It offers exposure to the largest infrastructure build-out in human history, the global energy transition, while trading at valuations that appear to ignore this exposure entirely. It provides optionality on the resolution of a supply-demand imbalance that worsens with each passing quarter. It delivers an inflation hedge rooted in 4,000 years of monetary history. And it does all this while sitting at prices that, adjusted for inflation, rank among the cheapest in its entire trading history. Whether silver represents the most undervalued asset in human history remains a subjective judgment depending on one's time horizon, risk tolerance, and confidence in the persistence of the trends discussed above. What financial historians can say with certainty is that markets displaying silver's current fundamental characteristics, structural deficits, depleting inventories, inelastic supply, growing demand, and prices far below inflation-adjusted peaks have historically not remained in equilibrium. They have resolved, often suddenly and violently, through price discovery that forces the marginal buyer and seller to transact at levels far removed from recent trading ranges. The only questions are when this resolution occurs, how high prices must rise to balance the market, and whether those navigating global financial markets will recognize the opportunity before or after the repricing unfolds.